Liabilities are unpaid debts for goods and services incurred by the organization. Examples include unpaid debts to suppliers, unpaid salaries and wages of employees, unpaid amounts owed to utility providers, unpaid liabilities to governmental agencies, and so forth. Liability accounts in the general ledger normally contain credit balances and are subdivided into current liabilities and long-term liabilities, including unearned revenue. Current liabilities are short-term debts owed by the organization and are expected to be paid within 1 year or the normal operating cycle of the organization, whichever is longer. They include such things as accounts payable for debts owed by the organization to third parties for goods and services provided to the firm. Salaries and wages payable for unpaid amounts owed to employees. Withholdings from salaries and wages of employees on behalf of city, state, federal government, and also other personal withholdings directed by the employee. Long-term liabilities are debts incurred by the firm which are agreed to be repaid over a year or beyond the current fiscal period. These are debts usually incurred to purchase big-ticket items such as buildings, office furniture and equipment, and operating machinery. Long-term liabilities may also include large amounts of cash borrowed to help finance the operations of the firm for several years. Long-term debts, usually represented by long-term note payable, may also incur interest charges payable monthly or quarterly, along with principal payments paid in installments or a lump sum at a specific time in the future. Unearned revenue represents a long-term liability for advance payments by customers for goods or services to be provided over a year later, in other words, at a future date. The firm does not earn the related revenues until the goods or services are delivered to the customer, at which time they are considered earned and transferred into earned income. Equity is also referred to as net assets or net worth and is the right of the owners to the value of assets remaining if all liabilities are paid off by the company. The equity section of the balance sheet is usually subdivided into owner's capital, drawings, and retained earnings. Owner's capital or equity represent cash or other resources invested by owners to start and finance the operations of the business. Capital resources invested in the business could include items such as machinery and equipment, office furniture, land and building, and the trucks, etc. Drawings represent withdrawal of cash or other resources from the business for personal use by owners of the firm, reducing the overall equity balance in the firm. The retained earnings general ledger account contains the accumulated net income or loss amounts of prior and the current operating periods. Thanks for watching this presentation.